Happy Thursday. It's a glorious Thursday. It's sunny outside. It actually feels pretty nice outside. Too bad I had to work inside. But it's not what I'm going to be talking about today. What I'm going to be talking about today is Amazon. And Amazon is not doing too good when the old sales department, unfortunately. It seems like their dominance is either slipping or something else is happening. I got my theory on that. But this story comes from CNBC. It's also another story I heard on the radio. I don't know if the story's going to get into it. But they reported something else is happening. But Amazon stock sinks 16% on weak fourth quarter guidance. That's right. It missed its third quarter results. Also gave disappointing sales forecast for the fourth quarter. And the stock sunk in the extended trading. That's right. Amazon on Thursday posted weaker than expected earnings and revenue for the third quarter and gave a disappointing fourth quarter sales forecast. Which is funny because I've been buying a lot of stuff from Amazon here recently. Earning 28 cents per share. Is that really what it is? Wow. Revenue is 127.10 billion versus 127.46 billion according to Refinitiv estimates. Here's how other key Amazon segments did during the quarter. Amazon Web Service 20.5 billion versus 21.1 billion expected according to the Street account. Well, I think Parler is probably the perfect example of why they may be losing on that one. I don't know if it was that was expected, but when you have a platform that's based on web services and web hosting, and you just kick off a website, you don't really tell the public why you did, other than they broke their terms of service. That's going to leave people scratching their heads and wondering if their data or their business model is safe with Amazon or another type of web hosting company that offers similar services. Advertising 9.55 billion versus 9.48 billion expected according to the Street account. Amazon said it expects a post fourth quarter revenue between 140 billion and 148 billion, representing year-over-year growth of 2% to 8%. Analysts were expecting sales to come in at 155.15 billion, according to Refinitiv. Revenue grew 15% in the third quarter, making a return to double-digit sales expansion, but it fell short of Wall Street projections. Like the rest of the big tech, Amazon has a rocky year so far as it confronts macroeconomics headwinds, soaring inflation, rising interest rates. Those challenges have coincided with a slowdown in Amazon's core retail business as consumers return to shopping in stores. I don't know if they're actually shopping in stores. Maybe they just want to get out, experience the world, go touch some pavement or some grass. The second time this year, Amazon results have been disappointing enough to spark double-digit percentage sell-off in April. A weak forecast for the second quarter led to a 14% drop in the stock. Under the CEO, Andy Jassy, who took the helm from founder Jeff Bezos in July of 2021, Amazon has responded to the rising expenses of aggressively cutting costs across numerous divisions in recent months. It shed warehouse space, halted some experimental projects, shuttered a telehealth service, and froze hiring for the corporate roles in its retail business. There's obviously a lot happening in the microeconomics environment, Jassy said in the press release, and we have We'll balance our investments to be more streamlined without compromising our key long-term strategic bets or whatever. Amazon's gloomy fourth quarter sales forecast doesn't bode well for the holiday shopping period. Analysts are already grinding for a humdrum season, with online sales expected to grow just 2.5% according to Adobe. Well, any growth in this type of environment is going to be a plus. Don't get me wrong. It may not be what they were expecting. What you don't want to see is the opposite of growth, which is loss. Now, if you're expected to make X, but you don't make X, you make X minus 2 or X minus 10, as long as it's not start off with Y and you expect X, as long as it's not Y minus 2 or minus 10, then it's still going to be good. It's still a good investment. So here, Amazon's early access sale held earlier this month could help juice year-end sales. Data collected by the third-party analyst signaled an event may be lackluster as shoppers feel the pressure of inflation. That's right. Inflation is going to be killing our markets here pretty soon. Jassy said in the release that customers' response to the new discount event and Prime Day hosted in July was quite positive. Amazon is rounding out a disappointing earning for big tech. Alphabet and Facebook parent Meta both posted earnings that fell short of expectations as they navigate challenging in the digital ad market. Microsoft wasn't immune, reporting softer than expected cloud revenue and weak quarterly guidance. Apple, which is also reported on Thursday, beat earnings and revenue but came up short in the core product categories, including the iPhone business and the service unit. The stock is trading lower after hours. I mean, Apple is just overvalued in my opinion. Operating income at Amazon fell almost by half from the year earlier to $2.53 billion from $4.85 billion. Amazon Web Services account for all of the company's profit plus some, as the cloud unit generates operating income of $5.4 billion. Still, AWS posted the slowest revenue growth since 2014, when Amazon began breaking out of results for units. Amazon advertising business was one of the bright spots in results, bucking the trend of its digital peers, Facebook, Google, and Snap, whose ads businesses have gotten whacked due to economic environment and Apple iOS privacy changes last year. Ad revenue surged 25% year over year to $9.55 billion during the quarter, which handily topped analyst estimates of $9.48 billion. Analysts have taken different approaches to their per share earnings estimates because Amazon's hefty investment in electric vehicle maker Rivian, which went public last year. Amazon reportedly net income of $2.9 billion in the third quarter, which includes a gain of $1.1 billion in value of its Rivian stake. Didn't know that they were doing a electric vehicle. Let's see here. What's this electric vehicle look like? No, it doesn't do pictures. It's just business. That's all right. We don't need to see it. But yes, I think the inflation, higher fuel costs, not knowing if we're going to get fuel in the future as we try to push for greener energy approaches, which we're not ready for. I still think we're about maybe 10, 15 years away from actually going to a green energy, which is electric vehicles, because the United States is awfully big. It's not as big as Russia, don't get me wrong. We're not the biggest country. But there's a lot of land from coast to coast, from Canada to Mexico, that needs infrastructure in place. And I think the private sector needs to step up and do charging stations building that infrastructure, but we also need the infrastructure in place to be able to use the charging station, because having a charging station with no power is pointless, is about as useful as a gas station without gas. And these are things that are going to need to be addressed moving forward with that. I think United States is probably in a better position than most of the European Western countries for sure, because we're not going full on crazy, because there's checks and balances before we hit the gone crazy movement. And that's where the other Western and European countries are at a disadvantage. When their government says we're going this direction, there is no legal system to buck and say, no, we're not. We're putting the brakes on this. At least in the United States, we have that option available to us, despite what the federal government's trying to push. But we have higher energy costs, which is driving up costs for everything. Now it costs more money to run data centers. It costs more money to not necessarily actually to purchase items, because they're accounting for the delivery fee. It could also go up because of fuel costs, because it's just going to cost more money, which is adding to the inflation. Not to mention, you had the Trump COVID bill, and you had the Biden 2 or 3 bill, the second and third bill for COVID, which pretty much printed over half of the money supply in the United States. If you look at the M cash flow chart, it has a steady increase, and it gets to COVID and it just spikes straight up, and it's starting to taper off a little bit now. Hopefully that goes down a little bit more so inflation can go down, but there's a whole lot of policies that's got to be made. Of course, you got the Fed that's raking up interest rate, and you got people that are making the same amount of money, but they have less purchasing power, which means that they're not going to go to Amazon or any store to just purchase expensive items on a whim like they normally would, because they don't have the same purchasing power. And that's pretty much, I think, what Amazon was trying to say, is that people just have less money. They have bills to pay. They need to spend their money on food and gas and their family before they go to luxury items as a new computer or something that's going to be fun. They're only going to the essentials, and unfortunately, the essentials are costing more, which is hurting Amazon's revenue when it comes to online shopping. And it's probably not just Amazon. Amazon is just the biggest kid on the block, and when they start to fall, you know that it's just a matter of time before all the other kids on the block start to fall, unless we have a policy change and people have more confidence within the economy. With that being said, that is my video for today. Please leave a comment down below if that all made sense. Do you agree with my interpretation of it, or do I get it completely wrong? Let me know down below. And please smash the like and subscribe button on any all platforms, or just a platform that you're currently watching on. But most importantly, have yourself a wonderful day, morning, or evening.